and it's the tax season. Ted Jenkin is the co-CEO of Oxygen Financial, and Ted, welcome.
Hey, good morning. Nice to see you. I know people are probably hanging out across the country, so it's
they're hanging out everywhere, and Ted is one of our great friends, and he's a great financial advisor and tax consultant, and we've got some questions that you people have sent in about the about tax season, and Ted's going to answer those questions in just a minute. But Ted, tell people how they could get more access to you and where they can click to get information on Oxygen Financial.
Well, this is still really a great time of the year to boost your bottom line. And if you look at the right-hand side of your screen, you'll see a link to Oxygen Financial if you want to ask me questions or follow up today after the hangout and learn more. More importantly, you see on there are some business mentoring sessions where you can get 2 months for free. I recommend that you really take a look at that. It's a great way to basically boost your bottom line and grow your business.
Yeah, and that's offered to the people to be able to have these mentoring sessions, which we do every week for 20 minutes, and we bring in great people like Ted that can give you information and knowledge that that you can trust and you can would not get in other places. And that's the whole notion of doing the mentoring session, is to bring you the best thinkers in finance and taxes and also in how to run your businesses, and the smarter we are, the better chance we have for success, and that we all know that if someone's got a college education, they have a better chance of a high school education, a better chance of a non-high school education, and the more advanced education you have, the better it is. And it's about, it's a process. It's never we have all the information we need, and so that's why we have the mentoring sessions every week, and why we have people like Ted Jenkin that come in here and share their expertise with you. And with that, Ted, I'm going to go and start with questions that our listeners and viewers and members have sent in to us, and let you have at it. I'm a sole proprietor incorporated as an LLC. What types of taxes should I be paying for my business? Federal, state, FICA, Medicare, and so forth. That's Jacob from New York asking that question. Go ahead, Ted.
Yeah, I definitely want to answer that. I do want to say in the mentoring, I feel for a lot of small business owners, Fran, because it's hard to spend the money or your equity to have a board of advisors. And I always felt like participating in these mentoring sessions and those that listen to them, you almost get your own board of advisors during the course of the year, which is unbelievable. So I'm enjoying being a part of these, and I know it's great for small business owners. Now, let's talk about LLCs. There's really 4 types of taxes that you need to think about if you're an LLC. Now, you've got estimated taxes, which really we're talking about federal and state. A lot of this is going to be dependent upon your net income in the LLC, but you're going to have to estimate your federal and state tax. Now, we've also got self-employment taxes. Unfortunately, when you're not an employee, you get the benefit of paying what's called to be FICA and Medicare. It's 6.2% for FICA, and that'll be up to a certain dollar amount, and then 1.45% for Medicare, and that's a perpetuity tax. It goes on forever and ever and ever, and eventually it can get larger if you make more money. That recently changed a couple years ago. The last couple things to think about are unemployment taxes. You've got FUTA for federal unemployment taxes, and you may have state unemployment taxes, and the last one, depending upon your business, could be sales taxes. You really need to check into this because things have changed on the internet. You just got to make sure that you don't get some bill down the road for sales taxes. So that's good for a starter on the LLC.
Okay, that's good. And now we have Jana from Washington State. I recently started my business. I've always had taxes taken out of my check for me. I read Ted's post on the Go Small Biz blog on estimated taxes and wondered if he could expand on it a bit more. How should a business owner structure bank accounts to plan for these taxes? How should I go about determining what payments should be?
Well, Janae, I'm glad that you watched the video, and I hope it was some helpful information. But let's talk about this again. Once you have your business, you need to make sure that you separate church and state. And what I mean by that is you need to keep your personal accounts not commingled with your business accounts. Inside of your business accounts, think about having 2 accounts. One is an operating account. This pays the business's bills and your monthly run rate. And then the second is having an estimated tax account. Now, it will depend on your tax bracket, but I'm going to say at a minimum that you're going to want to save between 20 and 25% of every net dollar that comes in the business into that estimated account. And then the last thing I would recommend is making sure you set up your quarterly schedule. So in April, June, September, and January, excuse me, you're making those quarterly payments.
Boy, it's good to have those disciplines, and you need to do that, and that's really good advice. Don from Florida. I've run my print shop for over 25 years now, and I'm starting to think of retirement. During the recent recession, I used a great deal of my personal savings to keep my business afloat. Haven't we all? Now things are starting to turn around, but I don't have a great deal of savings to fall back on for my retirement. I was counting on selling my business and using the profit as an impromptu 401k. Is this a wise strategy? If not, do you have any advice on a different path I might take?
Well, Don, I want to say congratulations, first of all, for making it through that recession. I know a lot of small business owners were hit hard, and it's a credit to you to be able to have sustain that downturn in the economy and come back to even be in this position to have this question. That being said, the first thing I would just make sure is if you haven't done a quick and dirty business valuation, you want to figure out what your business is worth. Because if you're going to sell it, one of the questions is, can the net profit or net proceeds from the sale build you out an actual retirement income? That's going to be important. You're not going to be able to sell your business and use the profit after sale to set up a 401k. But I will say this, Don, if you're just a year or 2 or 3 years away from retirement, a 401k plan is not the only plan. The government still allows you to set up things that are called defined benefit plans, which are pension plans for folks that are a little bit older and closer to retirement that may allow you to save a lot more money than you can put in a 401k plan. So I would look at those because ultimately I know you to recreate your paycheck, and you'll have to see what the balance is between the sale of the business and how much you can bank away in retirement plans.
Let me ask you this. So many entrepreneurs, I think jump the gun in selling their businesses that are cash flowing businesses. If someone's going to buy a business, a small business, and you're cash flowing that business every year, $200,000 or $300,000 a year, say, do you price it on a multiple of cash flow, a multiple of revenue? What methodology? If I'm selling, what I want to look at?
Yeah, I mean, different industries will operate slightly different. A good example is if you have a technology business, you may be able to get somewhere in the nature of 6 to 12 times revenue. It could be that big. But if you're in a service business, like most of us are, you're either going to get somewhere between 4 to 6 times cash flow, your EBITDA, as they call it, your net profit in the business, or it'll be around 2 times, 1 to 2 times revenue. So Fran asked a good question here, which is you need to be careful because sometimes when somebody waves $1 million, it looks like a lot of money, but if your business is cash flowing $200,000 a year, that $1 million just isn't going to recreate you $200,000 a year.
I had someone come and offer some money for a business that we have, a teleconferencing business, that cash flows a lot of money. And when you look at the multiple of that, and we're cash flowing the cash flow that we had, it didn't make sense to us. When you've got a business that's spitting off cash, you've got to be very careful before you throw that under the bus and take the lump sum cash money, because that's it for the cash flow.
Oh, there's no question about it, Fran, and I think it's one question a lot of business owners don't ask themselves when they start a business is this going to be a lifestyle business, i.e. generate cash flow, or is this a business I'm going to scale and sell? And there are 2 very different models about how you operate the business.
Okay, here we have Laura from California. I've heard people say not knowing what you don't know is one of the most dangerous things for a business owner, and I believe that's true. What are some of the most common mistakes you see new business owners make when it comes to taxes, and what advice would you give them?
So I looked at this, and boy, we could talk all day about this. This could be a mentoring session in and of itself. But I will say to you that a couple of things to know up front. Number one is a lot of small business owners commingle money. That's a huge mistake. You can't commingle your personal and your business stuff. Trust me, it's not a good idea. 2 is You got to decide whether or not you want to hire family. Family can be great in the business, or it may not be great in the business. You have to set clear expectations about the jobs of people that work for you. 3, the structure of the entity. Are you going to set up as a LLC or a S corporation or a C corporation? The structure of the entity can matter. And then I'm going to give you 2 last ones. 4 is not capitalizing the business right, Fran, which means you got to know that you got enough money in the bank, or you got some line of credit somewhere in case your projections are off. And then the last thing is, I'm amazed about how many small business owners do not have a P&L. You have to be able to look at your business at the end of every month and say, did I make money or did I lose money, and why? And if you can't answer that question, it will be difficult to run your business.
Good answers there. Harry, have we got any more questions from our members or our viewers?
Yeah, we had a few a few good questions come in from Facebook. Lorenzo in Arizona wanted to ask Ted, under what conditions can a small business owner deduct meals for tax purposes?
Woo! Well, if you talk to small business owners, they'll say always. That just isn't the case. You know, they'll say always every meal is deductible. But I will say to you that the IRS has 2 tests. They have something called the directly related test, and they have something called the associated test. Now that sounds like a lot of fancy mumbo jumbo. So what I will say to you is that if you have a real business purpose, right, you're at a meal and you're actually discussing business, which I recommend that you do, and you've got a date and a time and a place and a receipt and a live person, the likelihood is you'll be able to deduct it, okay? If you're having McDonald's with your family, that's likely not going to be a deduction, okay? So it's definitely a gray area, but the more documentation you have, the better off that you're going to be.
That's such a good answer there to all you people. Keep records, keep records, keep records. And I know as an entrepreneur that's not something that comes natural to any of us. But it's a discipline that you really need to have because, as Ted says, you've got to have the records that back up what you're doing because it is a gray area. Okay, Harry, any more?
Yeah, no, just to add to that, you know, Ted wrote several blogs for us on Go Small Biz, and that was a running theme throughout, the importance of documentation. So if you guys haven't seen those blogs, go to Go Small Biz and check them out. A lot of really good information. So, yeah, we got one more question from Facebook. Winslow in Illinois wanted to ask, I'm ready to hire my first full-time employee. Do you have any tips or pointers from a tax standpoint, and is there anything I should look out for when I do that?
Well, I think that I think a lot of small businesses don't realize how big a step this is. When you were a business of 1 and now you're going to become a business of 2, you have officially declared that you're in management. So you better ask yourself, do you want to get into management? Now, if you do, my number 1 thing for you is to make sure you have an employment agreement. I can't tell you how many business owners, they say, this is my friend, my pal, my buddy. Well, they're all buddies until the time they decide to leave your company. So you want to make sure that you've got documentation. You also want to make sure that you're set up with the Department of Labor so they know that your EOL number established, and make sure that you've got your normal forms, your I-9s and your W-4 set up, and you've got payroll set up, right? Because once you hire an employee, they're going to pay their payroll tax, FICA and Medicare, but now it's going to be your job to actually withhold and pay out that payroll tax as well. So you want to make sure you get that all set up.
Ted, one other thing that I would like to ask here, it's not so much about taxes, it's about how much cash should a small business entrepreneur keep on hand as it relates to whatever his revenue is or so. I really like to have a lot of cash on hand for that particular rainy day. And if we have a dip in business for a month or a year or so forth, I like to be able to have a backdrop of cash that I can draw on that's there to make me sleep better at night. Is there any formula for that?
Well, I don't know if there's a hard and fast rule, but typically, just like you would do in your personal finances, if you can get 6 months of a cash reserve, $20,000 a month in the business, and you can basically have $100,000 to $120,000 in the bank. If you hit a pocket, sales go down, you get a lawsuit, something goes awry in your business, then you do have that rainy day money. Or what about other opportunity to expand in your company? That's why it's important for a small business owner in that first year or two to build up a cash reserve before they start a business sometimes, because if if you start milking the business for all your cash and never have a cash reserve, you can get hampered during that rainy day. So I like at least 6 months of bills in the business.
Well, I hope this has been helpful for all you people out there, and thank you for joining us. And we're here every week, and you can continue sending questions in to us, and let Harry know what subjects you would like to have covered, and we will respond to you. We want to be able to give you the information that you're looking for, and to be able to help you be smarter about running your business. And that's what this is all about. It's about helping entrepreneurs have the knowledge and information to make better decisions. Ted, any other last tidbit you'd like to give to our people before we go?
No, I just want to say I have great respect for the small business out there. It's a tough battle, but you're doing a great thing, and you're helping America become a better country.
Thanks so much for joining us, everybody. Have a great day.